Jeff, let's start off with yields and the message that's really being sent here. When you start to look at a 30 basis point move in just a matter of days here, is that bearish?
Not necessarily. I mean, we're looking at a brighter growth outlook. Certainly, the market's pricing in that tapering is coming. The market's also pricing in that some of this inflation is not entirely transitory. But there isn't necessarily one level of rates that's a problem. Often, when rates move up very quickly, it can stress out the market. The question of how fast financial conditions can tighten, but they're not really tightening here. And so financial conditions remain very accommodative. I think the market's just recognizing that global growth is actually booming, not just this year, but next year as well, given the forecast for about 4.5% to 5% global GDP growth. And along with that, more normal levels of inflation, 2 to 3% in that Fed comfort zone, rather than that 1% and persistent worries about deflation that we dealt with in the last cycle.
It's interesting, though, Jeff, because when I take a look at the NASDAQ 100, 42% of stocks are still off 10 to 20% from some of those record highs. The S&P 500, you're still looking at almost half that are down significantly from some of the recent highs that they've made. So what is going on underneath the surface versus some of the headline indices when we can go on and on about valuation with those?
Well, I think there are some worries about the earnings season creeping in here that we've seen in September that have pulled back some of these stocks. I mean, some people are focused on the margin impact of the supply chain disruptions, but the market may be figuring out that it could be much worse than lower margins. It could mean lost sales. You can fit 20,000 pairs of jeans in a 40-foot shipping container unit. The cost to ship that from Shanghai to LA is up $9,000 more than it was a year ago. But that's only 45 cents a pair, or less than 1% inflation on the retail price of a pair of jeans. But if they aren't on store shelves, it's a much bigger problem for the for the maker and for the retailer. And the markets may just be beginning to recognize this supply chain risk on sales going into the earnings season, hence the defensive rotation today and some of the distance from recent highs we've seen in September.
Now, I'm reading through your recent notes, and you have a great question in here, whether COVID-19 is still driving the rotation at all. And it's a particularly interesting question heading into the winter months. What role does risks tied to around the pandemic play?
I think it's still in there. It's been amazing all year. When the global case count for COVID has been rising, we've seen defensive lockdown leaders perform well, tech, healthcare. And when we've seen that case count go down, we've seen leadership by like energy and financials and industrials and value stocks and international stocks. And what should be happening right now is as the Delta variant fades and we start to see these case count come down, we should see a rotation into value. But as we get to the winter months, if we don't have a lot of booster shots being dispersed in time and we get into that typical seasonal pattern, we could see a tick back up again in COVID cases. And even though it may not mean the same number of deaths or hospitalizations as we've seen in the past, the market still seems to respond to this and certainly did so this summer. So that could be a concern, rotating back and forth again, maybe back into growth again as we look into the winter months.
Do you think the trades, though, get easier as we get sort of deeper into the year and into next year? Or is this going to get even more, just a lot harder, and people have to be much more selective than they have been?
I think in the U.S., you've got to be a bit more selective. I mean, the market, given where valuations are and the slowing earnings momentum and the potential for tighter financial conditions, but take a look around the world. Japan's stock market has been left for dead. And look what it did in the month of September. Best performing market in the third quarter. And it's got a lot of winds to its back as we go into the fourth quarter as well. You've got very good earnings momentum relative to the rest of the world. You've got this election season, which is usually very positive for Japanese stocks, combined with those low valuations. So I see a brighter outlook outside the U.S.
On that note, outside the U.S., outside the equity market, signals that you're getting within the credit space, Jeff, when you just have investment grade spreads over treasuries at 83, high yield spread over treasury, you're under 300. What is that signaling to you?
Caution in the fixed income space. We think you ought to be careful with high yield bonds here and long duration bonds. Shorter, bit more high quality portfolio makes sense to us here. Look, we're past the point at which you're going to make the easy money in the bond market. And now you're holding bonds for protection against those pullbacks in the equity markets and for a low but relatively safe yield going forward. So think shorter duration and higher quality as we're moving forward here over the next year.